For the current rate method, we call the process as translation. If your subsidiary is using their local currency, which is a foreign currency to us, then you have to use the current rate method. So let's take that same example. You have a subsidiary in Mexico, and the subsidiary company is using peso, and you have to use the current rate method. Following the chart, you will convert all balance sheet and income statement items from peso into US dollar. So this is a plain simple translation. Just like the way you translate a foreign language into English, you are also translating peso number into US dollar. And that's why this current rate method, the process is called translation. On the other hand, for the temporal method, the process is called remeasurement. Now, you also need to know a little bit about inflation. We know if your subsidiary is using the US dollar, you have to use the temporal method. If the subsidiary is using their local currency or a foreign currency to us, you have to use the current rate method. But what if the country where the subsidiary is located, there is huge inflation? So if there is huge inflation and you have to use the current rate method, and all those converted numbers will be inflated because of huge inflation in that country. That currency value will go down as opposed to dollar value. So if you convert those into dollar, those numbers will be overstated or inflated. And that's why for high inflationary economy, no matter what's the functional currency, you always have to use the temporal method. Now, how we will define an economy as high inflationary economy? So you have to look at least their 3 years inflation rate. If the 3 years cumulative or total inflation rate exceeds 100%, and if you think like of compounding inflation rate, approximately per year 26% in inflation in a row, then you have to use the temporal method. Now we will see one example. USCO is a US parent company, and they actually just started a subsidiary or owned a subsidiary in Switzerland. The name of the subsidiary is Swissco, and they invested 500,000 US dollar. So the subsidiary is located in Switzerland, Swissco, and assume that they are using Swiss franc, Switzerland's currency. And when they establish the company, the exchange rate is the same. $1 is equal to 1 Swiss franc. So that means these invested $500,000. If you want to convert it on that day, it's 500,000 Swiss franc. Then the Swissco subsidiary company, what they did, they purchased inventory, and the rest of the money they held as cash. So they spent 150,000 for inventory and the other amount as cash. So if you look at their opening balance sheet on the very first day you start the business, on the asset side you have cash 350, everything is in Swiss franc, and inventory is 150. On the other hand, you will see common stock and additional paid in capital. This is how they define it's given is 500,000. So then 1 year passed, you did the business, you have all transactions, revenues, expenses, you purchase assets, you might have dividend and few other items. We'll see these are the exchange rates given. For every problem, you will be given the exchange rate. So you purchased some plant property equipment and long-term debt, which is on March 15. Remember, for the temporal method, you may need to use historical rates. Historical rates means when you purchased or recorded those items first. March 15 rate is given. Patent, when it is acquired on April 10, the rate is given. Average rate for the whole year is also given, $5. When dividend is declared on October 1st, the rate is given. For dividend, we use historical rate, and it's always the day when we declare the dividend. Average rates for the fourth quarter is also given, and December 31st is the day when you prepare your financial statement or balance sheet. So this December 31st rate, $10 will be your current rate. On all others, if it's relevant to those acquired or purchased dates, though or dividend declared date, those will be the historical rates. So now we will see the current rate method. Current rate method is easy because for income statement, we always take the average rate. Since we are doing it for the whole year, we'll take 2024 or the whole year's average rate. And then we will also convert the balance sheet, and balance sheet also is also easy because all assets liabilities will be using the current rate. For current rate, we mean it's December 31st rate. And then we'll see how we end up with gain or loss and where it will be shown. Now, from the table that you have to remember, I'll show you here. In class, we'll write it down. If you remember current rate method, your gain or loss will appear on the balance sheet under OCI in your stockholders equity part. So we will see how we'll convert those. So now when we'll convert, we'll start with the income statements, and it's very easy, average rate. So you know average rate is given for the whole year. Don't take the fourth quarter's average rate. Rather take the average rate for 2024 $5. Now, here, this is kind of like the reminder when we will convert the income statement following the current rate method. You know, it's all revenues, expenses. We use the average rate, and the assumption is that is evenly occurred throughout the year. Even for depreciation amortization for the current rate method, we use the average rates. So the rates are given. Now you will see this part. This first column is their income statement in Swiss franc. Now look at that. Their net income number is 470,000 Swiss franc. Now, here we are doing the current rate method. Only one rate, which is the average rate for the whole year. So when we are converting, we are just multiplying every item on their income statement by the average rate. And after multiplying all these income statement items, your US dollar net income is 493,500. So let's take this net income number. And now we will see a statement of retained earnings. So just what we're gonna do for statement of retained earnings, in the dollar statement of retained earnings, we'll copy and paste this converted dollar net income, which is 493,500. So this is my statement of retained earnings. This first column is my Swiss franc column, and then the other column is the US dollar. So from converted income statement, we copied and pasted the dollar net income, which is from income statement 493,500. Now, if you look at the other items, it's the first year beginning retained earning is 0. Dividend, we declared it in Swiss franc, it's 150,000. We always use the historical rate, so we have to look when we declared the dividend, what was the exchange rate on that day. Dividend declared on October 1st. So on that day, exchange rate is $0.07. So historical rate is $0.07 for dividend. So we are converting dividends by using $0.07. So now this is how we end up with our dollar retained earning numbers. And this is how it's called, composite numbers, dollar retained earning numbers. So just remember, we will copy and paste these converted or composite retained earnings, the US dollar retained earning, $333,000, and we will use this as the ending retained earning on our balance sheet. And the other items we will convert following the chart. So now let's do the balance sheet. This is my Swiss franc balance sheet. It's a balanced balance sheet, isn't it? You see all items are listed in Swiss franc, all liquid assets, non-current assets are first, cash, receivables, inventory, then plant, property, equipment. So total Swiss franc assets is 1,670,000. Same thing if you look at on the liabilities and stockholders equity side, Swiss franc, it's a matched balance sheet. Total liabilities and equity is 1,670,000. So this is my Swiss franc balanced balance sheet. Why I'm using the term balanced? Because if you see total assets, it's always and should be equal to total liabilities and stockholders equity. It's a balanced balance sheet. Now what will happen if we start converting? Now following the current rate method, all those exchange rates, I'm converting all the asset items and liabilities items by using the current rate. So this you don't need to memorize. I'm taking you here. This will be given during the practice problems and your exam. So when we are converting assets and liabilities following the current rate method, we are using the current rate. But for the stockholders equity part, we are using historical rate and retained earning is composite. Now, after converting the asset sides using the current rate, but the liabilities and stockholders equity side using a different rate based on their historical rates, and retained earning is a composite number, do you think the balance sheet will be matched? No, it will not. It's a simple algebra number things, right? So now if we look at the balance sheet, it's a balanced one, but we are multiplying the asset size by 1.1 $1.10, right? But for the liability sides, we have the historical rate. The first day when we started our business, issued our stocks, the exchange rate is different. For liabilities, long-term dates, we are still using current rate, but common stock, additional paid in capital, those are using historical rate. Retained earning, here we copied it from our converted statement of retained earnings, 333,000. So now here you will see up to this is total assets, $1,837,000. Now if you do all these, accounts payable, current liabilities, long-term debt, common stock, additional paid in capital, and this composite retained earning numbers, if you take up to this, it will not be equal to the total assets. That means when I am using different multiplier here and one number is copied and pasted, it will not be matched with total assets. So we need to plug in a number to match total liabilities and stockholders equity equal to total assets. And this number is nothing, it's just the results of your conversion. This number is the number what we call conversion gain or loss, and we are reporting it on our balance sheet under the stockholders equity part. And if you want to be very specific, we label it as OCI. Now, we have to plug a positive number to match the balance sheet to make the liabilities and equity equal to the assets. Since we are plugging in a positive number, we'll call it OCI, other comprehensive income, or it's a gain. Sometimes after conversion, you will see that you have to deduct a number to balance the balance sheet. That means you need to plug in a negative number, and that will be a loss. Here we end up with a conversion gain. So this is how we will do the current rate method.